Always look forward to talking to Dave. Hey, Steve, thank you very much. Great week. Nice crude call. Great to have you
Thank you,
back
Coach.
in the saddle, man. So, David Brady on deck. Great to have you back, David. I always gain insights every time we talk. So, looking forward to hearing your voice. Let's see if you're unmuted. You are?
Testing, testing. 1, 2, 3.
Okay, 4, 5, 6, my trading warrior brother. How are you?
I'm great, Dale. How are you?
Good. Great to have you here. How are things going in Canada? Everything going okay?
Well, we've gone from
Maybe.
snow to rain, so I guess it's a small improvement, but I'm
Yeah.
still waiting for summer to show up.
Okay. Well, when's it get there? In June, July?
It should be this month, actually. May is usually the
Okay.
transition month, but fingers crossed it eventually shows up.
So, to talking about summer, what's on your heat map? Oh, of course, I should have expected a PowerPoint and a nice presentation. So, David, I'm going to do what's difficult for me and try not to interject a lot and be a listener and learner to what you have to say today, buddy. So, it's all yours.
Well, Dale, as you know, I prefer an interactive discussion rather than me pontificating about what's going to happen, but
Okay.
I appreciate it. And just a quick comment with regard to Stylianos's comments recently. I was sending all those comments because I was really enjoying what he was saying and, in violent agreement with almost everything, which makes it a very dull conversation. But I was basically cheerleading in the comment section.
Yeah, he's one of the best.
Yes.
Because he gives a wrap up. You could walk into the market with not one idea, and after listening to Steve for 20 minutes, you have a lot of things to consider. So, when's the last time we talked, David? 6 months ago?
Yeah, November, I
Something like
believe.
that?
Yeah.
Yeah, before the crash, that you called that decline. You were there for the worst December since 1931. And then I remember you saying you're buying calls, and it was near the bottom, a little after the bottom. Did you expect the magnitude of this recovery to be new highs from the December, January lows?
I sent out a couple of tweets, one on December 24th, right at the lows. That was actually the day we bottomed, showing the 2008 rally. I believe it was from November of 2008. We got a 27% rally in stocks. Just said food for thought, guys, because everybody was bearish beyond belief at that point. We were at 23.46, give or take. And that turned out to be prescient. I sent out another tweet on January 6th saying I expected this to go to 2,800 by at least the March FOMC. But to answer your question, I expected a rally to 2,800, but it's pretty much long in the tooth at this point. I still consider this a bear market rally until the market tells me otherwise.
What would that be?
Well, I'd have to see a break of 3,200 on the top side to really, throw in the towel, because as we'll go through today, when I ask bulls, what's your rationale for why the market should keep going higher? I either get silence or I get momentum and the trend is your friend and so forth. And I'm a trend follower myself. That's the only way to trade. But at the same time, look at how far we've come from December 24th. And my presentation, the bulk of it this morning, is with regard to stocks and the numerous signals that we're getting now that the risk reward has clearly moved to the downside. This doesn't mean that it peaks today, but you have to get ready for at least a pullback. But potentially new lower lows. Those are the two main scenarios on the table. So without getting ahead of myself, let me just jump straight in here. So I'm going to go through a whole raft of signals quickly because there's so many. and I haven't included them all here. So, but this will give you a taste of what I'm seeing. So, for example, the S&P, despite its rally, is still negatively divergent on a monthly basis. It's also negatively divergent on a weekly basis.
Right.
So those are two warning signals. This is the RSP versus SPX. This is the equal weighted index as a ratio against the the standard S&P. And what I've seen in the past and what's happened in the 2008 crash is this tends to underperform the weighted index, the standard S&P, as a warning sign that things are in trouble. Everything under the cover isn't as rosy as you see in the big picture, which is the index level itself. So you can see here that the RSP peaked way back in December of 2016 and has never set a new high. Whereas, we know that the S&P has just continued to power higher here. And more recently, it's got a lower high and seems to be at a lower low, which basic trend analysis tells you the trend is down. And this is why, while the S&P continues higher, you've got the RSI, the MACD, both MACDs, showing that momentum is not supporting this further rally in the S&P either. So this is a warning sign for the bulls that this rally is running out of steam. And this is a breadth indicator. This is basically showing that the weighted index is going to new highs, but the equally weighted index, which discounts the fact that the FANG6 or FANG8 are keep going higher, is showing a altogether different signal. And let's get into some more breadth signals here.
Here's the new summation index. Don Mead has been talking about this rally, the quality of it, the inherent McClellan type of stuff is not confirming this move either.
Well, yeah, I respect Tom's work to a great degree, and he was right in saying that when we broke out to the upside on the RASI, the summation index, that there was more leg room on the upside, and that has proven to be the case. But we're at elevated levels now in the RASI, and it's coming off. And we're seeing the same thing right here in the new high-low index, which shows new highs have relative to new lows has peaked and is showing a lower high. Now, normally you hear the bulls say, "Yeah, but look at where it is." Yeah, I don't look at where the market is. I look at where it's going, and this signals to me that the risk reward is down from here, and we've got a lower high in the high-low index. And then let's look at the number of stocks above their 50-day moving average. Yeah, recently it was over 90%, but it's falling. You're seeing lower highs again in the number of stocks which are above their 50-day moving average, while the S&P is going to new all-time highs. This tells you that the number of companies participating in the end of this rally is falling. And that's a warning signal. And then again, look at the momentum indicators. They're all going down. So keep that in mind. This is the 21-day moving average daily sentiment index for the S&P. Now, this goes back to 2003. And the reason I show it is the average is at elevated levels, to say the least. The only time this has been higher has been January 28, just before January 2018, coming off the most bullish market ever, to be use a politically correct term, in 2017, where we had, I think, the least amount of 1% moves down in history. And then you go back. You have to go back to the QE, post QE in March 2009. For higher levels, and before that, 2006. It's hardly inspiring in a QE-free environment. Well, we could debate that, but the Fed is still undergoing QT right now, and yet we've got the sentiment at elevated levels. This speaks to extreme complacency, and I see this day to day on Twitter when I get responses from so many people saying it's only going up and so forth. That just validates my theory that complacency is becoming pervasive. It's widespread, and that's another sign. Like the mailman back in 2000 asking me about tech stocks. that you need to start looking in the other direction when everybody is on one side of the boat, as it were.
What was your reaction when you heard the Fed was going to stop QT in the fall?
Capitulation of the Fed. If you look at what happened in Q4, which, yes, predicted because of primarily there were a whole bunch of reasons. I don't just throw forecasts out, I don't shoot from the hip, as it were. There's a lot of rationale behind it. But the main reason for that, I expected that fall in Q4, was global liquidity turning negative towards the end of the year, and the markets would anticipate it. And indeed, that's what happened. When the buyback blackout hit in October, and global central bank liquidity was turning negative as the ECB was tapering to zero on their QE. The Fed was maximizing its QT, moving up to 50 billion a month in October. When you take those factors, and liquidity is the primary factor driving stocks. Let's make that clear. It's not earnings, right. It's not fundamentals, it's not the economy, it's liquidity, and that's the whole reason we rally from.
It's financial engineering too, right, David? I mean, this whole tax cut didn't go into plants and equipment. A great majority of it went into stock buybacks, didn't it?
Oh, absolutely. When I use the term liquidity, I'm not differentiating between true liquidity from day-to-day investors and institutions buying the market and being bullish. This is the most hated bull market in history. It's artificial liquidity. It's coming from central banks, corporate buybacks, you name it. It's completely engineered, in my opinion. But that's the reason why the stock market fell in Q4, and it's also the reason why the market rebounded in Q1. And we'll get into that momentarily.
Okay.
Now here's the what I call the hockey stick, and this refers to the 10-year yield curve. And when the yield curve, everybody focuses on the inversion of the yield curve. That's not the issue. The issue is when the yield curve spikes higher after inversion. And you saw that in 2000, you saw it in 2006, which was where both before the crashes occurred in stocks. And the reason for this is yields are falling at both the 10-year and the 2-year level. However, the 2-year is falling faster than the 10-year. Hence, the spread between the two is rising. And why is the 2-year yield falling? Well, it's poor economic conditions, negative financial conditions, and the Fed is cutting interest rates. So it's a sign of trouble for the market. Well, you can clearly see it worked in both both those crashes. And recently, we're seeing signs of potential bottoming in this yield curve. And I'll move to the daily chart. And rising. We had the bottom was in December, and we've had higher lows since. We ran into a brick wall at 21 basis points. But ahead of the FOMC, everybody got ultra dovish, given Trump's comments and so forth. Yeah. And then the Fed funds interest rate and reserves issue, the difference between the two, and expected the Fed to cut rates. Well, that's the reason why this popped up above that 21 basis points. It's come back down because the Fed disappointed.
Like it could be a false breakout and we're headed lower. On that previous chart, David, one thing I did notice I wanted to ask you about, the other two examples, the red line was underneath the blue line, and here the blue line is underneath the red line. Does that mean anything? You see the difference between the two previous examples of yields beginning to rise in your previous slide?
It is going higher. Just give me a second here.
Yeah.
In both cases, no, it's just a graphical. It's just the way the graph comes out when you use a long-term chart versus a short-term. If you look at the axes, they're the same and going in the same direction on both. So this is going up in yield terms. This is the S&P falling, and you're seeing the same here.
I see.
This is the S&P falling, and this is yields going up. So, so that's the hockey stick, and this is I call it the dreaded hockey stick because it's been extremely prescient for the prior two crashes. And if we see this happen again, you're gonna get an advance warning because it happened a few months It was shorter in terms of duration, the lag between the bottom in this and the peak in stocks in 2000, but you had a much bigger window of opportunity to short stocks in 2006. And if we see this spike higher, which personally I believe we will at some point, because I do believe that the Fed is going to be forced to reverse policy at some point in the near future. And they've been warning us about it since Powell was nominated. But we don't have to try to anticipate when this spikes. We just have to wait and watch it happen. And when this shoots higher, then you can feel more comfortable about getting short stocks in a big way. Now, this is another bond market indicator and credit leads. This is the high yield index. The high yield spreads relative to treasuries compared to the stock market. Typically, as you've seen in the past, these move basically hand in hand. They're very closely correlated on an inverse basis. But now you're getting high yields are diverging from stocks. High yield spreads are rising. Everybody talks about how great the return has been on the high yield index recently. But when you compare it to treasuries and you look at the spread, it's actually widening. And it bottomed way back in November, and it's still going up. Stocks, on the other hand, are also going up. It's supposed to be an inverse correlation. So something has to happen here to close this gap. Either high yields spreads come down or stocks come down. So that bears watching too.
Okay.
Then we've got the 10-year and the 30 years themselves. The 10-year yield peaked back in 2007 ahead of the S&P and dumped. And in October, last October, when the stock markets dumped, the peak in yields occurred, and you can see it here. And to the extent that this continues lower, it's obviously a negative signal for stocks, because why would bond yields fall dramatically? It's for a number of reasons, because negative economy, negative market conditions, and a substitution effect, because if stocks are falling, those flows are going to move out of stocks into a safe haven like bonds. And that's one of the primary reasons you will see this drop. So we've seen it peak in October and fall, but we haven't seen yields go back up after the rally in stocks in December. They're still down. And you've seen the same thing in the 30-year. And I love this 100-month moving average, by the way.
Wow.
It's been tested so many times over the past 20, 30 years. And it broke out briefly here. And I posted a tweet back then saying, buy bonds at this point because it's going to go back down. And here we are. Now we've got a nice little bounce here. But the monthly MACD, especially in the 10-year, is telling me that this has a lot further to go before yields bottom. We had the highest peak in history in October, and now we've got a long way to go to get back to these levels for a bottom in yields. Again, what needs to happen with stocks in order for yields to drop so precipitously? Stocks have to fall.
Yeah, flight to quality be the next part of the bond advance.
Yes, and then after that happens, the Fed reverses policy to QE, which means the Fed is buying bonds again, specifically treasuries, and the yields fall even further. So, so let's look at the VIX now. So the VIX has, back in 2007, we saw higher lows in the VIX ahead of the peak in stocks, and we're seeing the same thing again. Everybody's focused on how well the VIX is performing and it's supporting stocks. But when I look at it on a monthly basis going back to 2017, the higher lows, higher highs, that's an uptrend.
Yeah.
And we saw the same thing before the peak in stocks in 2007. So yet another warning signal even from the VIX. And then I have this. This is the futures chart for the VIX. Large specs are at all-time highs again. And look what happened the last time they peaked. The stock market didn't peak initially, but
these are people selling volatility.
Yes, shorting the VIX.
Okay. A few products disappeared.
Yes, but they're still doing it. They're obviously still doing
Yeah,
the future.
okay.
The future didn't go away, and they're shorting. They found
Yeah.
another way to do it. They're shorting it in the futures market. But as you can see,
Huh.
we can debate this, but having monitored the COT data for a long time, and Stylianos can jump in on this too, is that the specs are the dumb money, and what that means is they're wrong at extremes. So when they're all-time short at the most in history,
Wow.
typically it means it's going in the opposite direction, and the
Yeah.
same when they're long. And this chart clearly shows that. They got long down here back in 2018, post the 2018, January 2018 sell-off, stock
Yeah.
market went up. Then they got short again at the all-time highs in stocks, and down it went. They got long again at the bottom in December, and up it went. I mean, this isn't rocket science. And now here we are again, and they're back up to all-time highs. These guys never learn. And
Yeah.
the risk is when you couple this, and this is just the VIX. We talked to the bonds, we talked about negative divergences, etc. When you couple this with this, yeah, I'd be nervous. I mean, you've got an uptrend in the VIX itself as the stocks are going higher, and you've got the dumb money holding record short positions. It's a recipe for disaster.
Do you position yourself in any kind of VIX derivative, or it's just an indicator for you?
That's just an indicator from you. I don't play the VIX. I'm not in that game.
Okay.
Just a personal preference. I choose not to. I'd rather,
No, it's fine.
yeah, I'd
There's a
rather,
lot of decay, a lot of decay. They're almost like options sometimes
yeah,
because of contangos, and it makes my head explode. So I completely understand.
but it's a fantastic indicator. I
Yeah.
mean, look at this as an indicator. You can go back to 2015 or before, and it's the same deal.
Especially when it's going up and the market's making new all-time highs. It's really a pretty good tell.
Well, we just spoke. I mentioned the word complacency earlier, and this screams complacency again. I mean, we just had a 20% sell-off in stocks, and already, due to the market rally and the extent, this is what I was talking about. Bear market rallies are designed to pull everybody back in and then pull the rug underneath from everybody. And it's done its job extremely well, and it's not done yet. But this, if you look at the data and put aside your emotions, the data is telling you trouble is brewing here. This can go higher, of course, but the bigger they are, the harder they fall. And when I look at this and I look at the other cacophony of indicators, um, it says to me loud and clearly that this rally is running out of steam. The only debate that we should be having is, do we get a pullback, a healthy pullback, or are we going down to new lows?
Would you
So,
mind if I switch gears a little bit? Crude has topped last week at 66.5. It's had about a $5 sell-off. Do you think that they have been Siamese twins? Although the S&P way outperformed crude, they went down together, they rallied together. Is a potential top in crude another indicator? And then I also wanted to ask you about your view on precious metals as well. When this happens, is that going to be the time that we get a catalyst to the upside in gold?
so I'll deal with the first one first and come back to gold. The WTI, I agreed with basically everything Stylianos was saying earlier, and I see a rebound in oil here, potentially to a higher high. I'd be looking for a negatively positive divergence of that higher high to signal a top. But
Oh, so
that,
you're looking for over 6650, the high we put in a week ago.
the 50% fib, yeah. I'm saying it's possible. The other
Okay.
alternative, I'm expecting a rally, a rebound. Whether it goes to a new high or not is in question. But we could get
Okay.
the second scenario is we get a nice rebound, but we fall short of that 66.50 level, and it goes
Okay.
down. But I still expect stocks to go a little higher here. I'm looking for north of 3,000, and in order for that to happen, you can't have the WTI dropping to the 50s or the 40s. I mean, as you said, oil and stocks
Okay.
have been fused at the hip. So I think oil's nice. That's their healthy pullback, and I expect a rebound at some point here shortly. But this is just my opinion. But whether it goes to new all-time highs or not all-time new highs or not, that's in question. But certainly a rebound. With regard to gold. I've been saying, God, I write for Sprott Money for over a year now, that my primary scenario for a bottom in gold is a reversal in policy by the Fed to rate cuts in QE. All we've gotten is talk so far, and that precipitates the peak and fall in the dollar. And at that point, gold and silver will spike higher. And we got a taste of that ahead of, just around the FOMC. When the FOMC disappointed people with who had dovish expectations ahead of it, the S&P fell and metals fell too. But gold went back up there briefly. And let's talk about the dollar as well. The dollar ahead of the FOMC fell in anticipation of a dovish Fed, and then when the Fed disappointed, it spiked higher immediately. And there's a fantastic chart of dollar yen right at 230, where you've got a massive green candle right after the announcement. So gold fell as a result initially, but then as stocks continued to fall down to 2,900, gold caught a bid. And this was a sign to me, even though the Fed basically did nothing, it told us a few things. It told us that if the Fed is dovish and does revert to rate cuts in QE, the dollar will indeed fall. That's what it did pre the FOMC. And then when they disappointed, the dollar spiked back up. Stocks fell after the disappointment, and they were rising into the FOMC. So you got a clear indication of what would happen with the dollar and stocks. And this plays into your question, Dale, what happens to gold? Well, if stocks start to fall and then the expectations for a rate cut and QE, a return to QE, rise, you would expect, I expect, the dollar to fall and gold and silver and the precious metals and the miners obviously as well, all to rise from that point. That's my primary scenario for the bottom in gold and silver, is a Fed reversal in policy.
You really think, David, it's going to be that easy? All we have to do is wait for the day for the Fed to announce that they're lowering rates and starting QE?
I think it's actually going to happen ahead of that. I think, as we just saw at the FOMC, that the mere expectation that the Fed is on its path to cutting rates and returning to QE will send gold and silver higher. And said, is it that easy?
You have levels that are attractive to you?
Yeah, I have. At the tail end of this presentation, I was actually going to go through gold. But
okay.
Quick comment on this. This isn't just me shooting from the hip. Go back and look at 2008 and what happened with gold. Gold bottomed in October 2008, 6 months before stocks bottomed, even though QE was already underway. So gold anticipates, and it rallied from $700, $800 to $1,900. Given what happened with the recent FOMC and the action in the Dixie pre the FOMC in anticipation of a dovish Fed, why would we expect anything different this time? I mean, we can get into the dollar too, and the trend is your friend. But as you can obviously tell, I'm not a dollar bull. I expect a peak and fall in the dollar shortly, and for the reasons I just mentioned. Because two of the primary reasons for dollar strength is dollar illiquidity, dollar shortage, and the other one is relatively high yields compared to the rest of the world. Well, right. If the Fed reverses policy, you've just solved both of those. You're pumping dollars into the system again, and you're going to see yields fall. We talked about the hockey stick and the bond, the 10-year, and the 30. So that relative outperformance relative to the rest of the world, that's another leg of the stool that's pulled from underneath the Dixie. So that again plays into my thesis that when the Fed does decide or is on the path to cutting rates and returning to QE, that you will see the dollar fall and you will see gold and silver rise.
Okay. Do you think the dollar peaked recently at that 98.30, or some of the super dollar bulls are talking 99.20, 102, and then there's guys like Hendricks thinking 107, 120, something like that. Where would be some decent levels, or is it more about again, waiting for the Fed to verbalize their shift to easy policy.
Yeah, to actualize it. Yes, I have had 98, 99 on my radar for quite some time as the peak. I think it's going back to July of last year, the peak in the Dixie. I also said in multiple tweets, but you could get an overshoot to 101.60, and
Okay.
we could get into Fibonacci levels and so forth.
Okay, so that's still on the table,
That's
101.60.
as an extreme. That's my overshoot. But
Okay.
98, 99, we hit that. We could go back up there again and then fall. But to answer your question about the 107 and 120, I posted a few tweets there about 2-3 weeks ago, and I know there are two clear camps on the dollar right now. You got the dollar bulls, and there's a lot of very well-known names in that camp, and you got a few others like myself and Luke Groman in the other camp, looking for a dollar peak and fall. And the problem I have with the dollar going to 107 or 120 or 160 is, look what happened in August 2018. Everybody seems to have short-term memories. The dollar went up to 97, the Dixie, that is.
Yeah.
And
I saw that tweet, David, and you were talking about all the meltdowns that happened because of it, and none of it's happening now, right?
None of it's happening. Well, actually, it is starting again now. You're seeing Turkey's getting into trouble. Turkey's getting into trouble again. Argentina's getting into trouble again. But going back to August 2018, you had a global currency crisis on your hands, and that can quickly morph into a global financial crisis. Well, how? Because all of these countries have massive amounts of dollar-denominated debt. Well, who owns that dollar-denominated debt? The banks. And if there's any risk of default, and you saw this with certainly a number of banks in Italy, which were heavily exposed to emerging markets, UniCredit got, their stock price was cremated. The banks, if the European banks, which are on the hook to many of these emerging countries, but the US is too, but certainly the European banks, the global banking community is interconnected. So if any European bank falls and then another one falls, you get the domino effect. And soon that would spread globally. Now, yes, you could see the dollar spike as a result as a safe haven, but the US is going to get hit as well. And what happened next? The dollar backed off. It eased off a bit. It didn't keep powering up. It went back down to 95, 96, and we've been pretty much around there since then until recently. Now we're back up to new highs, and we see the Turkey and Argentina getting into trouble again. My point is, if we're getting this kind of tension around the world at 97, 98, how on earth is the world going to be able to suffer a 107, 120 Dixie? Somebody explain that to me.
Yeah, we'd be in the most severe deflationary environment since the 30s.
Yeah, you're talking global collapse.
Yeah.
I mean, simply put, because all the banks on the hook for all this debt would go under, and then the banks that are...
Deutsche Bank's chart doesn't look so good.
That's for sure.
I'm not buying calls on Deutsche Bank, but you know what? You brought up these emerging market countries, and I know that you watch everything, David, and that's why these interviews are great. I could ask you anything. I'm a little bit concerned about what's happening in Venezuela, not because of their oil, but because you have boots on the ground from China and Russia in Venezuela and us on the other side, and their reserves are larger than Saudi Arabia. And no one ever thought a flashpoint between superpowers would happen in South America. Everyone was always looking towards the Middle East. What's your view on what's happening there, and are people complacent about that?
Well, this is where I try to keep the tinfoil hat off, but I'll say this. If the global economy, including the US, is suffering a slowdown, potentially a major one, And this is a fact that is lost on a lot of people. Nobody's focusing on the fact that the Fed just went from hiking interest rates and reducing its balance sheet at 50 billion a month in Q4. Then we get a stock market drop of 20%, and the Fed immediately flips to, at least on a verbal basis, ultra dovish. Yeah, they're on pause now, but they can't stop talking about all the emergency measures that they plan to use in the next crisis. So that speaks to me, the takeaway from that is the second level thinking. Everything isn't as rosy as these guys are painting. They wouldn't be doing this if the economy was strong. Oh, this is a storm in a teacup. This is transitory, as they like to say. Things are really bad. I've been saying this, you know this, Dale, for quite some time. When you look under the hood of the global economy and the U.S. economy, you don't like what you see. It's negative. I believe we're already in recession. So my point, going back to your Venezuela question, is what's the best way to distract everybody from that?
War.
Let's start a little proxy war out in Venezuela, and that, you know, if there is any meltdown in the economy or in stock markets, you can blame it on a war in Venezuela. You know, wars are notoriously negative for risk assets. So that's number one. The bigger issue.
Go ahead.
Sorry, Dale, I just want to make another point. The bigger issue with Venezuela, I tweeted this back when Putin was doing high fives with Prince MBS of Saudi Arabia. The petrodollar, the Saudi-sponsored petrodollar, is at risk. Obviously, Russia and China are becoming great pals with the Saudis, much to the chagrin of the U.S. Well, now the U.S. is looking for an alternative. They need some kind of backing for the U.S. dollar if the Saudis decide one day to pull the plug. And, they would never do that. Well, look at the prospectus for the Aramco bid, their IPO. It includes a disclaimer saying that, you know, should the petrodollar basically end, these are the risks. So they're already talking about it. And you see how chummy they are with Putin and Xi. So the U.S. is looking for an alternative. There's no better alternative than Venezuela. They have the deepest reserves of oil in the world. So is it any surprise that they're engaged in activities down there? And John Bolton has made no secret of this. And on the other side, the Russians and the Chinese, the chess players, they're not about to allow the U.S. just simply like, okay, we can't rely on the Saudis anymore. We'll just switch to the Venezuelans. They've got them in a nice head hold right now, and they're not willing to release it just yet. So the Russians are putting boots on the ground and going, hold on a second. You can't just simply move the characters on the table around. And that could potentially...
Well, the Monroe Doctrine.
Yes.
Right?
Yeah.
It's being violated.
Well, yeah. Yes.
Well, it probably has been for decades anyway, but
exactly.
But it's really obvious here.
Yeah, former Jim Baker, he used to be in the Bush administration. He made some great quotes about that in 1994, how that had been violated so many times it'd make your head spin. But yeah, the fact is that a proxy war in Venezuela is possible. And if in my, I'm a cynic by nature because I'm Irish, forgive me, it's to distract from everything else that's going on. If it happens. So that's my 2 cents on that.
Sorry, I got you off track.
No worries. So we talked about the VIX, and now this is from sentimenttrader.com, which focuses on the smart money relative to the dumb money confidence in the stock market. And as you can see, the smart money has been, as we've known, the institutions have been selling this entire rally on the whole way up, while retail has been jumping on board, because I think the smart money sees the same thing I do, which is there's no fundamental rational reason for this stock market to go higher. So the smart money, as these are at the extreme lows. As you can see, you can just look back and I mean, unfortunately, this is only the past 1.5 years, but these are back to the lows for the smart money, and this is back to the peaks for the dumb money. And it's just another indication of complacency out there. Complacency is rampant after this rally, which is what a bear market rally is designed to do. Dollar yen, this is another signal I saw that worked very well back before the 2008 crash. Dollar yen peaked and fell dramatically. And this is, we all know about the carry trade. And this is the inverse carry trade. Dollar yen dumped and the S&P followed suit. Well, I don't know if you've looked at the COT report for the yen lately, but commercials are loading up long yen. And at the same time, if you look at the daily sentiment index for yen, it's down around 20. So the point that tells me is you've got the large specs are short yen, and the banks, the smart money, are long yen. And then I look at this chart, and then sentiment is extremely negative yen. The risk reward is that yen is going to explode higher here at some point, and that means dollar yen goes south, and that's
pretty tightly correlated with bonds.
Exactly, because the yen is another risk, a safe haven, supposedly. Right. We could get into a whole debate about the yen being a safe haven given their debt load to GDP, but as things
because there are bulls looking for 124 in the end.
Good luck with that.
Okay.
So I whenever I get into these things, I just follow the smart money, and the smart money is saying the opposite. Okay. So we'll see.
Yeah, that's a big part of your work. You love COT, and it really tells you how people are positioned, how they're sitting, if they're wrong-footed. I've noticed it's a pretty important part of your analysis, isn't it?
Well, yeah, like Stylianos was talking about with regard to the euro pound earlier, I don't get caught in the squiggles. I look for extremes, and when I see extremes in the COT data for whatever asset, and my process is called FIPEST, Fundamentals, Intermarket Analysis, Positioning, Elliott Wave Theory, Sentiment, and Technicals and Trends. And I use a multitude of tools together. I don't just use one. Right. I talked about this. And when the tools all point in the same direction, that gives me warning signs. I focus on data. I'm not interested in emotion unless it's a sentiment indicator telling me that everybody's bullish or bearish. And the data with regard to the yen, for example, the commercials are loading up long, and they have been for a while, and the specs are chasing the price, or have been chasing the price in dollar yen, and are increasingly short yen. And at the same time, you're seeing that the market is bearish yen with a 20% bullish index. So that tells me that the dollar yen risk reward is actually lower, not higher. But sometimes these signals don't work, but I deal with probabilities, and that's what they tell me. And if that indeed does happen, at the same time the stock market is, after coming off a 20% drop, has rallied to new highs, it's long in the tooth. There's no fundamental reason or rhyme or reason for this to go higher except artificial liquidity. I feel a rug pull coming. And whether it's a pullback, and we'll get into this shortly, pullback or new lows remains to be determined, but markets don't go straight up forever or straight down forever, as I said back in December. So the odds are against the S&P going much higher from here without a pullback. So this is short interest. Here's another case in point. No. The short interest levels are back to December 2017 levels. What happened in January 2018?
I mean, they've all been squeezed out.
Yeah, so what happened in January 2018? Just to illustrate the point. Yeah. And then that's just the S&P. Here's another one. This is a great chart. This is the combined short interest of the SPY, the QQQ, and the IWM, the S&P, the NASDAQ, and the Russell 2000. It's at its lowest since 2003. I mean, if that isn't complacency, I don't know what is. This market is primed for a pullback.
Really an interesting look.
Yes, and this is what they do. This is what artificial liquidity does. It squeezes the shorts. Well, they've done a fantastic job. And what have we got next? This is from Lance Roberts and the team at RIA. And this shows profits. We hear about strong earnings. This goes to my point about there's no fundamental justification for this rally. Profits before tax and after tax are more or less the same as they were, depending on which indicator you use, as they were in 2011 and 2014. There's an eye-opener for you.
Yeah. And the tax cut, and then they show the dotted line tax cut, and they haven't improved.
Exactly. I mean, you can't fight the economy forever, and the economy is saying something completely different to what the market is saying. That all these buybacks are there for a reason. It's to artificially pump EPS and therefore pump stock prices. But if you look under the hood and look at revenues, for example, the story doesn't hold up.
Well,
And then,
maybe we peak on the Uber IPO because here's they're going to go crazy over Uber, right?
yeah.
Who knows how it's going to go off? Could go, explode and fail. But anyway, here's a company that has admitted, all these IPOs, but this company has admitted they don't think they'll ever be profitable. They actually said that.
Mm-hmm.
Okay, they say they're a platform.
Yeah.
Okay, and they will never be profitable. This is coming from the company,
Mm-hmm.
and watch how people buy it. And with the company saying we're never going to make money.
Yeah.
What?
Define.
Does that remind you of 2000 with a dot at the end of any stock?
It reminds me of a whole bunch of things, but yes, that's one example. I would say negative interest rates across like a third of sovereign debt around the world is another one. Negative interest rates. You want to borrow money from me, Adele, then I have to pay you. Sorry, what?
Yeah.
Common sense just broke down there, and then you just gave me another one. This is another example of, well, why are they negative? It's because people believe they're going to become more negative. That's simply it. They think that bond prices are going to go even higher. So even as dumb as it is, and it doesn't meet the common sense threshold, if you think that the asset is going to go higher price and the rates are going to go even deeper negative, you buy it. Well, the same with Uber. They're never going to make any money, but I think the stock price is going to go even higher because I am oblivious to all the data in the market. I'm going with emotion, and everything tells me it's going higher. So,
and they gave me a ride to the grocery store.
Oh, I took fantastic service. Every time I have to bring my car in for a repair, I use Uber.
Yeah. All right. And, so this is the highest reading ever for this indicator.
Yeah, this is the Crescat micro model. Which is based on 18 proprietary indicators that they use, and it jumped off the page at me because it signaled the peaks in stocks in the late 1990s. It also signaled the bottom that followed in the 2000s and back in 91, and then the subsequent peak in 2006, 2007, the bottom in 2009. I mean, it's got a perfect track record so far, and look what it's saying right now. It's saying what everything else is saying, that get the hell out of Dodge. It's extreme overvalued. Now, could this signal not work this time? Sure, it could. But when you start putting all of these pieces of data in, how can you ignore it? Oh, because I'm long. That's why I ignore it. So anyway, that's the, I think it's that.
So let me just take a shot in the dark here.
Yes.
You're bearish the stock market.
Oh no! What made you think that, Dale?
I mean, just a lucky guess, David. So you presented one of the best bear cases I've seen in a long time.
Well, thank you, Dale. And this is a key point I want to make here. I'm bearish the stock market, but I get trolled all the time on Twitter. Well, how's your portfolio doing? I'm not short.
Yeah.
I'm not short because I'm a trend follower. So what I'm doing is I'm waiting for this to peak, then I'm waiting for it to break support, and then I'll jump on board.
Okay.
And that level I'm currently looking at is 2860. If we break 2860 to the downside, would follow through below 2785. See ya.
And you need volume, right?
And volume, and that's another. I haven't even got volume here. Volume's anemic on this rally.
I had a guy on. We had a high volume day. I think it was March 22nd, and he said if we have another down day with that kind of volume, that's his go. So, and that was based upon Spider, I believe, David.
Yeah, and that plays into my thesis. That plays perfectly into my thesis, Dale, on what the peak and fall here shortly. I think, as I said, I'm looking for slightly north of 3,000 before we peak here, which would tie into another big volume day, 30-50, 30-30, whatever it is, and down we go.
But on a trade deal, maybe?
Yeah,
I know. It's symbolic. How about if the Chinese, they don't look? you've talked about China with me several times about they think in terms of 100 years. We think in terms of election cycles here.
Right.
So why do they even want to hand Trump a symbolic victory?
But I think it's a mutual interest issue here.
Okay.
It's not just about helping Trump. I don't really think that's the issue. I think
I mean, they would be okay without a trade deal, wouldn't they?
Well, exactly. I mean, I've said since day one that the Chinese are in the driving seat, and I got trolled tremendously on Twitter for that. But it was obvious to me because, look, the US were enforcing demands, were making demands on China. Have you never known a Chinese leader to cow down to a foreign power saying, do this, do that?
No.
It was obvious from day one that Xi was never, ever going to lose face by cowing down to the US and Trump's demands. Ever. And look at what they were asking for. You are not allowed to continue with your China 2025 plan. You're not allowed to provide subsidies to the industries that you're promoting. And this goal of, being your growth goal is, we find it insulting, basically. And the Chinese were saying in their media, and I read the Chinese media to get the other side, they were saying that US is trying to curtail our ascent. They're trying to slow us down. That's what this is all about. And to some extent, it's true. Now, the IP issues are valid, but you're not going to be able to dictate to China. China consider themselves on a par with the US. They don't consider themselves a little minnow, and certainly when they've got the Russians in their back pocket as well. So it's never going to happen. Just take a stand back from the weeds, go to look at the forest, and it's just obvious to me. And when I see these trade deal headlines and Kudlow rolling them out, I try to go on Twitter and mute the word trade deal. I don't want to see any more tweets about it. I'm so tired of that nonsense. It's just solely to drive algos. And it works because they're machines and they can't detect bullshit. But that's all it is. There's no rhyme or reason. And look, there's this story, a kid story called Cry Wolf, and that's what we're getting. They're saying, trotting out the same headlines forever, and they keep punting it down the road. And it never comes to fruition, and I don't expect it ever will. The only way this gets resolved if the U.S. climb down, and I've never known Trump to climb down, but we'll see. So this PowerPoint is with regard to the China stimulus. I was making a point there recently that, why haven't the blackouts, caused stocks to fall again in January and in April, David? You were saying they caused it in October. Why? Well, the market was saved by China. China did massive stimulus in January to help the market get out of the doldrums to the tune of 5% of its GDP in 1 month. And then I was shocked to see them do it again. They announced it again in March, just ahead of the next buyback blackout. Now, again, liquidity is all that drives stocks. And this is certainly a factor. They filled the gap left by the absence of buybacks. And but the problem is now Xi came out after this latest one, and if they're true to their word, which is not always the case with the Chinese, he said that they're done with this stimulus. So we'll see how the summer goes, but it's not looking too good from a liquidity perspective if the Chinese aren't around to bail out the U.S. When the next buyback window comes around. What
about the signal we're getting in copper, David? I've been negative up there at that $3 level, and this looked like a pretty severe breakdown this week. That's implying? I mean, to me, that doesn't imply strength in China.
No, it doesn't. China's the biggest commodity buyer in the world, and
so what's going on with copper breaking down?
Well, the global economy is slowing.
Okay,
it's confirming what we already know.
Okay, so Dr. Copper, I said, Dr. Copper is in the emergency room because he's being sued for malpractice for impersonating a bull market.
Yes, he's in there with nat gas and soybeans.
Yeah. So, can you see like 220 copper down the road here?
Well, I did say that 225 is possible if we get another deflationary crash. Certainly a big pullback coming. But
and that's not really cheap copper. I mean, see how our things have changed. I was a commodity broker when it would trade 70 cents.
I know, and then China showed up.
Yeah,
But and then aided by the US and the exorbitant privilege, but a whole other debate. But
yeah,
yes, the copper, and I have to make a comment with regard to soybeans. Nobody gives
okay,
a hoot about soybeans. Soybeans are the best indicator out there of the possibility of a trade deal. Simply put, I've been saying it since the dawn of time. Every time it looks like initially, when we didn't get this cry wolf scenario, soybeans were popping ahead of positive headlines of a trade deal
yeah,
because China imports a ton, of, many
right.
millions of tons of soybeans from the US, and then it dived. Well, now we're still getting these positive headlines. It seems like daily, as Sven Henrik likes to say, and soybeans are getting crushed right now. They're saying there's no way in heaven this is happening. Just go pull up a chart of soybeans.
Yeah, yeah.
And
DSI is like 9. I don't think I've ever seen it there.
yeah, so my point is that you got to look at the data and ignore the BS that you're seeing in the media. And the data is telling you the actions of the traders and investors and the big money is telling you there is no trade deal. Now, we're back to copper. Copper isn't alone. There's other signals. Oil is a very manipulated market. Let's be honest. It's controlled by a few big producers in the world, but copper is telling you that the global economy is slowing, and that shouldn't be a surprise to anybody, as far as I'm concerned.
Yeah.
So trying to get through these. So this isn't just me being bearish. I got a few friends, just like I did for the 2018 call. Jeff Gundlach, he expects the market to be negative year to date by the end of the summer at the latest, and that means that he expects the stocks to peak sometime in May or June. And he's not alone either. Russell Napier, deflation, inflation. I couldn't agree. Well, I've said this before. He came out with this, but it's nice to see somebody of Russell Napier's caliber come out and say it. No QE, no bottom. If the Fed wants to return to QE because they need to reflate the economy, they need to inflate away the debt. They have to. So the QE is inevitable, in my opinion. MMT is too, but to the extent that they need an excuse, and that excuse, a pullback's not going to provide it. I'm getting ahead of myself what I'm going to say later, but a pullback's not going to do it. A crash would do it. A crash is an ample excuse, a 30% drop to new lower lows, and you will see the Fed return to rate cuts, QE, and what I call monetary insanity on steroids. And Russell Napier expects the same. He's basically saying that the Fed needs to go back. They need to inflate away the debt, and in order to do so, they need a recession or some kind of deflationary event to enable them.
The pain of deflation. So real estate prices be affected by that too?
Yeah, but only in the retail price. Real estate prices are already getting hit hard, but
are they? Not here yet.
Well, no, you're seeing we're down around 20% in Toronto, and I'm seeing it in areas like California is maybe still going up, but the slope is down. And actually, I saw a chart recently show it's negative for the first time since 2007, I believe. But the point is that it could go down a little further, but then lo and behold, the central banks, especially the Fed, are allergic to deflation. They will ride to the rescue. They made that clear. They're talking about negative interest rates. They're talking about policies they previously turned down, using any emergency measure to turn it around. They will throw the kitchen sink at this, Dale. And that's why when we get this sell-off, whatever it's a pullback or new lows, I'll be buying, because these guys are going to pump stocks like to a blow-off top around 4,000. We talked about that in February of 2018, you and I.
We did.
And I still expect that to happen. Larry Fink, one of the best contrarian indicators out there. I think the chart says it all. He comes out at the peaks with all these optimistic.
How does he keep his job?
Oh, I don't know.
Because he's the CEO. Why did they keep him there? Because maybe he's their contrarian indicator, and they get short every time he says it.
Well, I was going to say this is what he says publicly, but in private he's doing the exact opposite.
Oh yeah, that's right. He needs people to distribute his position to.
Exactly. So the latest comment is he sees a risk of a melt up, not a meltdown. Okay, sold.
Yeah.
That's yours. I'll give you all my stocks. There you go, Larry. Yes.
Okay.
See you later. Now, technicals. This is from Sven Henrik, and I
Yeah.
won't get into the details of this, but basically you can see the trend lines working.
Yeah.
But these are long-term trend lines. This chart goes back to 1987, and you can see the connection of the troughs and the connection on the peaks going back to 2007 and 2009. And
That's a beauty.
Look at where they meet, and then look at the line down the middle between the two, and that level at the top there is just above 3,000, and it occurs, and the timeline is October, and we'll get more into that in a minute. But this is a technical indicator going back years, and it's got multiple trend lines that all intersect at the same point. It would be amazing if this plays out exactly as predicted, and you see a major drop from here.
Nice.
And then you've got from him and his wife Mela this megaphone pattern, which I've seen elsewhere too, showing again a move up to just above 3,000, but then
down to 2150,
and then down to 21 to 2,200, which has always been my target since day one.
Yeah.
Be interesting to see if that plays out too. But that's technical basis. For we've gone through a lot of data and intermarket analysis. Here's the technicals. Now let's talk about Elliott wave theory. This is the count I have for the stock market rally since it bottomed in March 2009. And we completed wave 3 there at 29.41. And some people believe that this wave 4 drop to 23.46 that's the correction. We're done, and off we go in wave 5. We're in wave 1 of 5 now, and wave 2 pullback will follow. The problem I have with that, I have several problems with that analysis. It may be true, but here are my problems. I don't think a pullback is going to justify a Fed reversal in policy to rate cuts in QE. I think they're going to need more than that. The multitude of signals I've just gone through suggests the next downturn is going to be bigger than this. There's just too many signals saying we're going south, and there's so many people that have been sucked into this market. So many retail players have been put in. The complacency is widespread. It just seems ripe for a deeper drop. But most of all, from an Elliott wave theory perspective, look at the wave 2. Back in, it lasted 3 months from May to July of 2010. And that's your wave 2. And it's a small little drop and it lasted 3 months. Typically in Elliott wave theory rules, if wave 2 is small and short, wave 4 is big and long. That's just
alternation, rule of alternation. Okay.
Exactly. Well, wave 4 was from October to December. It was 3 months. Now, yes, arguably it was bigger than wave 2 in terms of size, but it was the same duration. I'm leading to the second scenario for the reasons I mentioned and the Elliott wave rule, that we've got another leg down coming. And
so new highs could be what they call an irregular B because it takes out the high of the previous
expanded
high.
Flat. That's expanded flat.
Oh, there's Steve Volke.
Yeah.
Expanded flat. And there's another reason for that. If you remember, Dale, when I provided my forecast back in February 2018, I said that I believe that we would go up to 3,000 or slightly above, 3,000 plus, and then fall. Well, we fell short of that. We got to 29.41.
Right.
Typically what you see in Elliott wave theory is when the correction comes, if the market has missed a predetermined target based on Fibonacci levels before, on the B wave level in the correction, it goes up to hit that level, to fill the gap it left behind. It should have visited 3,000, 3,050. It did not. It fell short of it and then fell. The next time around, you get an expanded flat, as Stylianos was saying, and it fills that gap, and then it goes south. And that's what I think is playing out here. And the MACD, for example, here, the long-term MACD, this certainly looks to me like it's going to go back up to the signal here, and then turn south again. And that'll create much more energy for the blow off top, I expect, when the Fed reverses policy. Because as I said, I think you said you're a bear on, you're bearish the S&P. I am now, but I'm not a perma bear. Once we get this peak and fall, I think we're going to 3,500 to 4,000 on the S&P next. So this is a buying opportunity.
And that'll be with a big bear market in, that'll be the reflation trade. Everything goes up except probably bonds and the dollar.
Well, actually, I would include bonds because the Fed's going to be buying every piece of debt.
So bonds could survive a massive round of QE.
Yeah, but they're going to have to throw the kitchen sink at this, which I fully expect them to do.
But the dollar won't.
No, this goes back to Luke Roman and another Irish chap called Lewis Curran. They came up with this US trilemma theory we talked about again back in February 2018, and it's basically this: the Fed has they have
it will sacrifice the dollar to keep the game going.
They have three areas of focus, exactly. They have three areas of focus: stocks, bonds, and the dollar. Well, stocks are key to the economy because the U.S. stock market. Yeah, the U.S. stock market is 150% of GDP. A massive amount of the tax receipts are taxes on IRA distributions and capital gains taxes. So it's key to the budget. So they can't allow stocks to fall. The U.S. would become insolvent because their revenues would dump. Or at least the perception of insolvency. Well, it is insolvent. Let's be called a spade a spade. The bond market is also key because of the sheer amount of debt and how fast it's rising. If interest costs on that debt balloon, and the CBO has already expected it to become the biggest expense on the US budget by 2030, but if yields spike higher, you can move that date forward to 2020, 2021, because the debt is so big, and if the yield increases dramatically, so does the interest cost on their budget. So they
can't let it happen.
They can't let stocks dump, and they can't let bond yields spike. So they have to prop up bonds.
Sacrificial lamb is the dollar.
The dollar is obviously going to be thrown on the sacrificial altar. Yes. Okay. And that's what's going to happen. I fully agree with that thesis. So that's what I expect. They're going to throw the kitchen sink at this, and the S&P is going to go to 4,000. I think everything else goes up, and this goes back to gold and silver. Gold and silver, if you're debasing the currency and the dollar does crash, along with every other currency in the world, even if they look the same relative to each other, when you go out to buy a can of Coke, it costs you like 10, 20 bucks. The gold and silver are a hard asset that are going to explode higher, and it doesn't matter what the paper markets do because everybody will want it at that point. But we're getting ahead of ourselves. But that's my anticipation.
I'm stacking it now, bro.
Yeah, well, you and me both.
Okay, so anyway, David, you know what? Let me ask you this, David. Why don't you show your website for people that I know this was a great interview and people are going to want to stay in touch with you on Twitter and go into your website. And you have chat rooms and you do this during the week, a few times a week or something like that, where you get together with your subscribers.
My wife says 24/7. Too much, but no, I'm on it every day.
You're helping her with the new baby. I know you're helping her.
Well, we got 4 kids now, so there's four of them. So but this is my website. I'm on it like daily, and it's globalprotraders.com. You can find me at globalprotrader on Twitter. But it's a free market forum for people to exchange views in the markets, and based on any data tool that you choose to use, all opinions are welcome. And because it's an extension of my own methodology, which is to use multiple tools instead of focusing on one. I'm not a purist on Elliott waves, technical analysis, fundamentals, sentiment. I like them all because they've all got merit. And when you have all those tools say the same thing as they did in gold back in December 2015, it was going higher. It was a no-brainer as far as I was concerned. Load up and that's the thesis. That's the core thesis of my process and this site. And yeah, I welcome anybody to join in. It's free, and I think my members have found it to be great use, and I found it to be great use too, because I can't see everything. And these guys are like my little army of a big army, I would say. Well, nice. Little that go out and they're reading articles, and they'll post them in this chat room.
Yeah.
And there's some great nuggets. I got one on gold yesterday talking about how the physical holdings of the ETFs, particularly GLD, are being drained, and the reason they're being drained is the bullion banks are having difficulty meeting delivery requests, and they don't want to spike the market by having to go out into the open market and buy the gold. So what they're doing is they're raiding the storage areas of the GLD and the trust companies' holdings. And I found that, like, and these are not like just willy-nilly guys. These guys have been reporting on this forever. And those are the kind of nuggets that you get at this site that I find extremely valuable, because the day when physical scarcity overwhelms the paper futures market in gold and silver is when it truly explodes higher.
Which is inevitable.
Well, David, you're doing a fine job. I consider you a watchman for the community, the trading community, investment community at large, by sharing your views and collecting intelligence, and really appreciate the time that you spent. It's a new record as far as time, and it's one of the best Bear Cases presentations I've seen maybe since I started doing F.A.C.E. So appreciate it. Thanks for edifying our community today, David.
Thanks David. So much. Thanks, guys. One last comment. These downtrends in gold and miners, watch for a break of the downtrend, the lower and lower highs for the next break up, in my opinion. I completely agreed with Stylianos' read on it earlier, and I said so in the comment section. But you can see that there's a clear downtrend. When you see this downtrend, and we see a previous high broken, that's a warning sign that these are going up. And thanks very much for having me on, Dale. I always appreciate it. It's great talking with you guys.
Okay, David, my trading warrior brother, David Brady, what a way to wrap up the week. Manny, thanks you, David, Giars, and Leopold, and this will be out on Twitter in a few hours. So, David, have a great weekend, good hunting, and let's get back in touch later in the summer, fall, and see how things are playing out, and really appreciate I learned from you today. So, thanks, my friend.
Thanks very much, Dale. I really appreciate it.
Okay, guys. All right, so everyone, don't just count your pips, count your blessings. You're welcome, Amir. Have a great weekend. Do your homework so you're not impulse trading next week. Thank you, Steve Volge. Thank you, Blake. Thank you, Grega. Thank you, Joe. Thank you, Amanda. Thank you, Stelios. Thank you, Andre. Thank you, team. Best team I've ever been part of. And you guys should become part of it too. I'll see everyone on Monday. Adios. Enjoy. Smell the roses. Money comes and goes. Time is gone forever. Make it count. Smile. Adios.